Welcome to Market Peeker. Successful trading isn't just about picking the right stocks, it's about managing your risk. Today, we're talking about the risk-reward ratio, a vital concept for every trader. What is the risk-reward ratio? The risk-reward ratio compares the potential loss on a trade to its potential profit. For example, if you risk $100 to potentially make $300, your ratio is 1.3. Why does it matter? Protects your capital. A good risk-reward ratio ensures you don't need a high win rate to stay profitable. For example, with a 1.3 ratio, you only need to win about 33% of your trades to break even. Promotes discipline. It keeps you focused on quality setups, avoiding trades where the potential loss outweighs the reward. How to use it. Before entering a trade, identify your stop loss, risk level, and take profit, reward level. Aim for a ratio of at least 1:2 or higher to maximize long-term profitability. Pro tip: combine risk-reward analysis with position sizing and other risk management techniques to safeguard your account.